All right. So this evening we have Sam Lowry and Tim Kane joining us from Belrose Storage Group. Sam is the Chief Marketing Officer and Tim is the Chief Development Officer and Head of Acquisitions. Belrose has acquired 19 self-storage facilities totaling 4,248 units now and growing. So thank you so much, Sam and Tim, for joining us this evening to share your wealth of knowledge in the self-storage space and give our group a 101 on how to start investing in this very interesting asset class. I will go ahead and hand it over to you to dive in.
Great. Well, good evening, everyone, and thank you so much for joining us. We're absolutely thrilled to be here. We have a lot to cover this evening. Please don't be overwhelmed. I promise you, we're going to try to keep this, very light and really want to spend the time after we kind of go through the deck to connect with you and answer any questions you might have. But I think it's safe to say that most of us here tonight are familiar with self-storage, and many of us have used it at some point. I know I certainly have. However, it might not be the first thing that comes to mind when you think about investment opportunities. Before working with Belrose, I hadn't given much thought to self-storage as a distinct asset class, but I have definitely learned a lot this past year. Tim and the rest of the team have been instrumental in kind of bringing me up the curve. So we're really excited tonight to be able to share why we believe self-storage is such an intriguing niche investment opportunity and why it may be worth considering for your own portfolio. So I'm just going to begin with kind of a brief overview. And as I mentioned, we view self-storage as a niche investment within the commercial real estate sector. So it combines elements of industrial and retail real estate, but maintains unique characteristics as a very distinct asset class. So some similarities with industrial and retail include property classification. So self-storage facilities are categorized into Class A, B, and C, and that's based on age, location, and the amenities that are offered. It benefits from a diverse customer base. Storage serves both individuals and businesses. Economic resilience. Storage demonstrates stability during economic downturns, which is very similar to essential retail and certain industrial sectors. Conversely, there's some unique features, and this includes flexible management structure. Storage is effectively minimal maintenance metal boxes. You've got keyless 24/7 entry. You don't need a full-time staff on premises 5 to 6 days a week. This then translates into smaller teams and lower costs. You have monthly rental option versus year-long or multi-year leases. Storage operates on monthly leases, which allows for frequent rate adjustments and easier eviction for non-payment. Plus, the owner can pursue a lien sale to auction off the tenant's belongings to recover any unpaid rent, which is such a plus. Lower operating costs. Less maintenance and fewer costs. There's a common saying about self-storage, which I've learned. It's no tenants, no toilets, and no trash. So effectively, less headaches that are commonly associated with other real estate, like office buildings. And then just the case for self-storage investments. So storage, high and stable demand. Self-storage units are in constant demand due to life events, and we call these the 4Ds. Dislocation, divorce, death, and downsizing. Impacts all people regardless of the economic climate. Storage is an asset class that's resilient even during economic downturns. Flexible business model. Short duration, monthly rental options can attract a wide range of customers. Those looking for short-term solutions versus being locked in and paying for something that they don't need. Storage is effectively metal boxes. They don't require a great deal of maintenance, which results in lower operating expenses and CapEx. Now, don't get me wrong, it's not completely maintenance free, but there's a lot less involved when you're housing items and not people. Growth potential, increasing urbanization, and rise of e-commerce. We've got retirees downsizing. They're moving to the city, but they're not ready to part with some of the treasured items they filled their large single family homes with, and they're putting it in storage. Or you've got younger adults, they're living in an apartment, but need a place for their holiday decorations, their skis, their surfboards, seasonal clothes, you name it. What they need is access to storage that they lack at home. So this is combined with the rise of e-commerce. Last mile delivery, all the buzzwords. The demand for same day, next day delivery will only continue to grow. Retailers need storage solutions for inventory to meet that consumer demand. So The storage sector is well positioned to not only expand, but also evolve to meet the needs of both individuals and businesses alike. So, mom and pop industry. The ownership composition of the self-storage industry is quite unique compared to others in the commercial real estate sector. Ownership's fragmented. It's not dominated by large institutional players. Mom and pop facilities make up a significant portion of the self-storage market, approximately 75%. So what do we mean when we say mom and pop? These are small, family-owned, or independently operated facilities. They're usually smaller, have fewer units, and less complex operations. Owners typically manage the property themselves and/or with minimal staff. They may not use advanced management software or marketing strategies. Owners will often look to sell when they're ready to retire, which helps create a fairly steady pipeline of off-market deals. And seller financing. Mom and pop owners may be open to seller financing options, which can make acquisitions much more accessible. So what does this all mean for investors? It provides opportunities to acquire facilities, modernize operations, and increase profitability. So now that sounds very simple and straightforward, but the devil is in the details, as they say. So Tim is now going to share with you the signs of opportunity that the Belrose team looks for in an acquisition and the best practices they implement to capitalize on their investment.
Thank you, Sam. And thank you all for joining tonight. Really excited to meet all of you and tell you about this boring, beautiful asset class, which is so important to be right now, right? So boring is beautiful is our theme tonight, Sam.
Wow.
And why I say that is this is just a great commercial real estate asset class that banks love and is very predictable and has a low barrier to entry with an experienced team of operators. So the first thing you want to do is look at the signs of opportunities. And in our world, which Sam was just describing with the mom and pops, they're usually mismanaged. They offer too many discounts. Think of a small hometown where they're a small business owner and their kids all go to the same school and they see them at soccer practice and they just want to be popular. They want to be 100% full and keep things simple, right? For a lifestyle that they would like. That is not sophistication in business. It's great for them, but what we have found is this is an unsophisticated asset class heading in the right direction. But when you implement professional management opportunities, it's really, like Sam was saying, devil in the details, meaning, value pricing, dynamic pricing. It's a lot like, it's funny, it's a simple asset class, but we follow things like the airline model and the hotel model. When you only have one unit available, that's extremely expensive, just like a last seat on a United flight. That's a middle seat for $700, right? So you bring sophistication to this asset class, and that is where it is really, you get robust returns. So going back to the signs of opportunity, they're ineffective on the collection strategies, meaning their delinquencies are high because they don't have systems in place to follow up and have easy collections over the phone or on their website. They've neglected maintenance. They offer minimal or no tenant protection. That is just an add-on it's just like protecting your assets. It's very inexpensive, but small business owners that aren't with the times, they're not offering that because they don't understand it. And it's just a very low you can capitalize on. And the big thing is the first generation of storage owners, it's typically passed down in generations, small businesses, or they just own land back in the day and they just decided to build storage for themselves and their friends or family. So it's the generation, it's the baby boomer generation that is, the biggest transfer of wealth is happening, right, in modern history. And this is part of it. And these owners have gotten used to this fixed income and this lifestyle. So we have discovered, and Sam's going to talk about that later on, ways to have a win-win when we take over ownership involving seller financing and other creative financial structures. But how we capitalize on the opportunities, We bring up, just like I was just talking about, we bring everything up to market rates, meaning that we actually do the research, check the competitors, and make sure that we are.
Tim, it's cutting out a little bit on my end. Is it cutting out on anybody else's end?
It is.
Yeah, it's strange. For some reason, it cut out a little bit a couple times. Maybe just repeat that last sentence or two. Now there's no volume.
That's weird.
Yeah. Do you have a speaker or Bluetooth or something hooked up?
We can't hear you.
I guess he can't hear us either. Oh, you can hear us? Okay. Well, we're halfway there.
How about now?
We
Yes.
can.
Perfect. Thank you.
All right. So I was on just how to capitalize for signs of opportunity. So basically, to expedite this, we take in sophistication and we make best business practices to make sure that our rates are competitive and we're offering a premium product. And the big thing is we want everyone to feel safe in our facilities. That means over 60% of our clients are women, and we want to make sure that it's well lit, people feel safe, there's cameras, and it's all about feeling safe when you're going there at 10 o'clock at night by yourself to go grab something real quick. You want to make sure that you feel protected and safe, and that is something that we always capitalize on, and a lot of people do not think about, but it's extremely important when someone's spending $150 a month for holding their belongings. Okay, next slide please, Sam. So the deal life cycle, this is similar to other asset class that Mariel and the group has seen. There's a chronological order that you go off at every deal. But since 2019, Belrose has just rinse and repeat. We're on our 20th facility now, and we've just got a team that everyone has their individual skill sets that we've just gotten really good at because, again, it's a copy and paste model. And then we learn something every single time. So you first start with sourcing the deal. That is prospecting to, what Sam was saying, 75% of these owners are still mom and pop, meaning non-extra space storage, non-PE firms. These are just ABC storage, LLC kind of situations. So we source these deals. We've got a prospecting team that I head up that we are calling 300 facility owners a day. And that takes a lot of just consistency and continuing education. And it's not only cold call outreach, we're sending mailers, we're negotiating with brokers, we're going to conferences, conventions, educating ourselves and networking. So we always have a robust pipeline. It took years and years to get that, but now we do have it, and we have the team to be able to go to the next step. So when a lead comes in, it's a very low conversion rate. If anyone comes from the fix and flipper world like I did in the DC area, you're sending out 100, you have 100 leads, and out of those 100 leads, there's only 10 good ones where the numbers work, and then you send out 3 offers and you get 1. It's the same thing in storage. It's not rocket science, it's just hard work. And when you have systems in place, it really helps. So you source the deal, then you underwrite it. So our team has learned how to underwrite it. It's more than just a residential underwrite, or it's more similar to multifamily, where you're actually looking at market analysis, you're auditing the financials, you're doing property inspections, environmental inspections to make sure that the bank will lend on the property and that you're not setting yourself up for failure. Legal documents, finance options, and you're looking at rent rolls and the trailing financials to make sure that everything checks out so you feel safe closing on the facility with the financials. You're aware of everything. You have all the rent roll, the occupancy report, so you know what you're getting yourself into. Then after sourcing, underwriting, you go into the management planning, and that's just simply deciding on their management approach. Are you going to be an owner operator? Meaning if you have the time and efforts and the ability to learn how to manage, maybe you could save a little coin and manage it yourself, meaning you're fielding the phone calls and et cetera. You can also hire a third-party management, a lot like multifamily or other asset classes, but that is simply where it's more hands-off. You still have to asset manage and quarterback and police the third-party company, but they're handling the day-to-day. But of course, that comes at a cost. So it's all about that underwrite. And if you are going to third-party manage, make sure it's in your underwrite so you don't get that wrong. Then you simply evaluate the data that you've collected from the due diligence, analyzing occupancy rates, identifying opportunities for operational improvements, things like adding security and cameras, like I was talking about earlier. And then during the evaluation, then you negotiate at this, just like any other asset class, you're negotiating the best terms for you and your team. So you're submitting your letter of intent and you're negotiating the purchase sale agreement with the seller. So you're going back and forth and you're negotiating things just like you would when you're buying a house or buying a mobile home park or a business. And then closing, this deal life cycle is usually 45 days of due diligence, and then you usually do 30 days after to close. So it's about 2.5 months per facility for closing. And then you're actually, going out there and securing your financing, completing all paperwork, doing all your legal, and then actually transferring the deed. Sam, next slide, please. And I'll speed it up. I know that was a lot of content there. So deal sourcing, this is where, the bread and butter is. You control the deal. You won't be successful if you can't source deals or if you don't have the team or the resources to do so. So we do multiple sourcing methods that I was probably breaking in and out of earlier, but that's through off-market acquisitions, brokers, peer network for off-market deals. We use virtual assistants. We use international virtual assistants. Right now, we have found a pocket in the Philippines where they have great work ethic, good culture, and they're really go-getters. And we really, it goes right in hands with what we like to do. And the funnel process for warm leads, direct engagement from acquisitions and team members. So it's all about the follow-up, and Mariel, I know with what you've been, in your background in real estate, and Sam and what we do with the team, it's very unlikely to call a mom and pop owner, offer something over the phone, and then send them the paperwork to say yes, right? Very unlikely. It's good old-fashioned hard work and follow-up through a proper CRM, such as Podio or Monday.com or whatever you feel comfortable with. We personally have a system that we like. It's called Fuel Point, and it's just thousands and thousands of facilities, all about the follow-up. And that's really where the one we're closing on next month took 3 years of following up to get this facility. So it really, you got to have that pipeline if you want to scale, or at least you want to be a part of a team that has that access. So to break that down, we review over 1,200 leads per year. 14% of them only meet our criteria because, as we all learned, it's all about the deals you say no to, right? It's okay to be picky because if you have a robust pipeline, you can be and cherry pick, because at the end of the day, you want to be as profitable as possible. Only 7% of those were sending out offers, and 0.35% of those, that's tough to just even read and say out loud. That's a lot of work to get under contract to move to the next step. So it's all about, we're a big KPI company, key performance indicators. We just have so many different checks along in our system that allows us to be able to close frequently. And the deal analysis. So when it is a deal, it's worth pursuing, and if it meets the following criteria. Just like I keep comparing residential because I feel like that's an easy example. It's just like if you're going on the multiple listing service or Zillow or whatnot, and you're looking at comps, and it's the same kind of due diligence, but you're wanting to see positive demographics. You're looking to see that the median income and the population trends are in your favor. As you can imagine, you wouldn't want to go into a city where everyone is leaving and that it's not on the path of progress. So we actually identify the area first before we underwrite the deal to make sure that if we build it or if we acquire it, we're still going to the facility is going to be feasible and your business is going to do well. So storage is very hyper localized. That is where I think it sets apart from other asset classes and other businesses. Marielle's not going to drive to Delaware to save $20 a month from DC. She wants to pop into her unit, grab her seasonal clothes or grab the furniture or whatever it is 1 to 3 miles away, especially in our area. You don't want to go more than 5 miles. It's an errand at the end of the day, right? So it's all about convenience. So what that means is we base our things off of supply index, and not to get too granular, but it's just the high level is there's so many square feet per capita that each area has that you want to make sure that you're not saturating the market. So it's so crucial to do a proper feasibility study, to do your due diligence, because it's a large acquisition and you could have the fanciest, nicest storage facility in the area. But if there's too many other facilities, the rates are going to tank and no one's going to move in. So it's very, very, very important to do your research. And our team does that along with experts around us. And then we look at the physical condition, the year built, the maintenance, just like in any other asset class, the CapEx. For example, if we have to put on a new roof, doors, add security, the operations, who's operating it? Is it the mom and pop? Do they have someone full time? And are they implementing technology? That's the other thing that has changed in storage. We've learned about this during COVID. It was already on the path of technology heavy, but COVID really expedited this process, meaning that on all of our facilities, you go to nextdoor.com, which is our brand, Nextdoor Storage. You can rent a unit in 3 minutes from your phone. You get a gate code, we get your driver's license, and then you can, at our 19 facilities, you can rent that right now. So and then you can pull up to the facility and open the gate with your phone. It's all about, and that's how we can scale, and that's how we can have 4,000 units with not that many people. And that's the other great thing about storage. It's very scalable and tech heavy, where you can have a lot of facilities, but not so many headaches managing people. As we all know, the hardest thing in any asset class or business is people, right? So we just keep A players around us, and then leverage technology to grow. And then the last is opportunity to drive value or reach maximum potential and selling close to the top. We buy at the best terms possible for mom and pops. We improve it. Let's use the residential again. It's a fix and flip. We buy a distressed asset. We implement our professional management, physical and digital footprints. And then a lot of times we'll expand as well, because the larger operators want a turnkey product as big as possible. They want to write big checks, but they don't want to do the hard work in between. We're the middle people here. So we buy from the owner operators, but then we sell to the big companies that will pay a premium for a turnkey product. And we're a niche inside of a niche that understands that. And we've sold 5 facilities like that so far, with robust returns that our investors have stuck with us. And we have a lot of repeat investors doing the 8th wonder of the world, compound interest, with us. And next slide, please. And due diligence, I'll fly through these because I went pretty in detail. But you got to do your DD. You got to audit the financials. You got to look at the market. You got to do your inspections. And you got to have a kick-butt legal team to protect you. I can't tell you how many people are scared to invest in good legal teams, and then something happens 2 years down the road, and it's because you cut corners on that. It stinks. It's boring. You got to look at every single word. But I can't tell you how many times we've been able to reference a contract and we have gotten out of sticky situations because of that. Next slide, please, Sam. Deal financing. One of the best things about storage is banks love storage. Boring, boring is beautiful, right? Meaning this is the lowest default rate in commercial real estate, 1.4%. Banks love storage. Even in the DC area, we have one in White Marsh, Maryland. We're refinancing tomorrow with a local bank. We didn't have to shop around at all. They absolutely loved it because the default rate is so low. And it's at the end of the day, it's an asset, it's a cash flowing asset. So banks absolutely love it. You've got to understand the different types of loans. You can go government SBA loans. You can do private loans, such as seller financing, which Sam will talk about. And then you can also just do your normal institutional loans, just like you were to go get a normal mortgage. We're usually leveraging ourselves in the 65 to 75% loan to value, but the barrier to entry is low for the small business association, where you can leverage this thing up to 90%, meaning that you don't need as much capital as you think to be an owner operator of self-storage. Next slide, please. And I'll end on this and pass it over back to Sam. So why we love self-storage. It's low risk. We just talked about that. Banks love that. You do your homework. It's low expenses. If you take it seriously and you surround yourself with experts, you're going to succeed. It's in high demand. It does well in great markets when people are buying things. It does well in bad markets when it's cutting it tight and they need to downsize. So it is resilient, and it's always going to be in high demand if you follow the things that we just spoke about. It's a stable, boring income stream. You can go invest in a fancy hotel. You can go do whatever you want to do with your investment portfolio. This is the stable income stream one. This is check the box on the boring mailbox money. This is the one you want, and you need this in every portfolio, right? The economic durability, it's low maintenance, as we've described. It's a flexible business model, meaning if you just want to do one facility in cash flow, great. If you want to do 30 facilities in cash flow and leverage technology and bigger teams, great too. There's a lot of ways to skin the cat. And the last thing is what investors love is tax advantages. The depreciation and the cost segregations and the interest expense deductions are phenomenal in storage. You see a lot of 1031 buyers. We'll get an email come across, 1031 buyer needed, up to $100 million. All it is, it's family offices deferring their taxes. The high net worth individuals absolutely love storage because you have the stable income stream with the tax advantages. It's stability, consistent returns, resilience to economic fluctuations. Thank you all for listening, and I'll pass it over back to Sam.
Great. Thanks, Tim. So the next two slides provide an overview of the ways to invest in self-storage. And Belrose is in a unique position because we work with clients both on the active as well as the passive side. So let's start with active. And what do we mean? So active ownership involves directly owning and operating a self-storage facility. So some potential benefits to active ownership include full control over operations and decision-making. You've got the potential for higher returns through hands-on management. And you've got the ability to implement value-add strategies directly. So ultimately, you are the owner and you are calling the shots. So some potential drawbacks may be it requires a time commitment and a level of expertise within self-storage. You're responsible for day-to-day operations and management, and you're dealing with any tenant issues, maintenance, and emergencies that may arise. So you're the owner and you're responsible for the facility's success or failure. And then next, let's take a look at passive investments. So passive ownership, it allows investors to benefit from self-storage without direct involvement. So examples include investments in REITs or passive syndications. Some potential benefits to passive ownership include minimal time commitment and responsibility on your end. Professional management handles all the day-to-day operations, and you can diversify across multiple properties or markets. You're an investor, you've committed capital to entrusted operators who are experts in self-storage. Some potential drawbacks: reliance on third-party management, which means less control over individual property decisions. Also, potentially lower returns compared to active ownership because you're sharing in the profit with others. In this situation, you're the investor and your capital and potential return is not in your control, you're relying on a third party, which is why operator due diligence is so critical. So, how to decide what investment option works for you. And, some key things we encourage anyone we work with to consider are, how much time do you have available? Active ownership requires a time investment, while passive ownership is more hands-off. Your level of expertise. Active owners need in-depth knowledge of self-storage operations and real estate, all the things that Tim talked about. Passive owners, they need partners who possess this knowledge. What's your capital situation? Active ownership may require more upfront capital for direct property acquisition. And then ultimately your desired level of control. Active owners have full control while passive investors rely on management decisions. It's a personal decision. Only you can really decide what will work best for you and your lifestyle, but there are plenty of resources available so you can do a deeper dive on both options. And Tim and I are happy to help direct you in any way we can. And then lastly, what's in store for storage for 2025? So heading into the new year, I know we're almost at we're heading into March. It feels like it's been such a whirlwind. I can't believe 2 months have already gone by, but the outlook for 2025 is positive and we're anticipating sustained demand. And this is going to be driven by urbanization and increased real estate prices, which we all know about increased real estate prices. So we're going to see this particularly among renters and businesses who will be affected. Alternative uses, expansion into other storage such as boat and RV, small business inventory storage, and e-commerce fulfillment. These are offering new growth opportunities beyond traditional residential storage. Focus on optimized pricing strategies. So dynamic pricing models, they balance competitive introductory rates with the structured existing customer rate. This ensures sustained NOI growth despite any market pressures. We're going to see tech-enabled smart solutions such as digital leasing, advanced security, mobile apps, all which are designed to provide convenience and enhance security for customers. Specialization. We're going to see multifaceted storage solutions offering large format and climate controlled options. Sustainability. So increased adoption of eco-friendly features and amenities. And, back to the boring is beautiful. The projections over the next 5 years have the self-storage market at nearly $50 billion by 2029. The demand exists, and we believe storage will only continue to grow and evolve.